You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
All right, everybody. That music means it is time once again for Options Playbook Radio, what the cool kids call OPR, aka your weekly source for some options plays, information, offensive and defensive use cases for options that you can utilize in your own portfolio. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from the ever compelling, at least we think so, Options Insider Radio Network. We're glad to see really so many of you are enjoying Double Pro Week. It's been a busy week on the pro front. If you're not sure what the heck I'm talking about, check it out for yourselves. Theoptionsinsider.com/pro is the place to go for all the information out there. You'll see we had 2 great Q&As this week. Heck, you're getting a double dose of Brian fun today for all the pro listeners that can join in live, ask questions out there as well. And of course, you have oddities and everything else coming up later this week for you folks. So check it out. Theoptionsinsider.com/pro is the place to go to learn more. And of course, if you're saying to yourself, he's not the usual guy on this show, you are correct. So allow me to welcome on the usual host of this program, aka my partner in all things OPR crime, Mr. Brian Overby, the options guy himself, also hanging out over there in the land of Ally Invest. Mr. Overby, welcome back to your own program, sir.
Well, thank you, Mark. And I like the concept of us being partners. I got to admit, I love it when we are able to get together and answer some listener questions. We've been able to do that a little bit more recently. So let's get together and huddle up.
It's time to huddle up and answer questions about your favorite options plays. Submit your questions via twitter.com/options, facebook.com/theoptionsinsider, or questions at theoptionsinsider.com.
All right, everybody. Brian, a lot of people want to get at you today in the huddle. You folks listening live on the pro front, you can always join the party as well, get some questions in live as well. We're going to burn through as many as we can here today, Brian. Let's start with a fun one. Let's go to the heart of one of your favorite strategies, which I know is the old skip strike butterfly. Nims wants to know, what is Brian's criteria for determining when to skip a strike and when not to with a butterfly? So like I said, Brian, this is kind of one of your go-to bits of strategery out there. When you're setting it up, when you're skipping those strikes, how do you decide when to do it and when not to do it?
Oh, I love this question. That's a lot of times you just have to look at the options and determine, well, if I skip this strike, doesn't make sense to do that because I can get it done for a net credit. A lot of times I will look at some skip strike butterflies, and actually was looking at skip strike butterflies in NVIDIA, and it just isn't working. And part of the reason why is that there's a lot of vol skew on either direction. A lot of times it's harder to do a skip strike butterfly on the downside because the further you go out of the money on the puts, the vol increases, which means it's harder to get done for a net credit to the account because you're paying up for that way out of the money put. Well, NVIDIA, which I've been looking at recently because of the split, has the same type of thing going on, not only on the put side, but on the call side. So it's very hard to look at that underlying and come up with a way to do an actual skip strike butterfly and get it done where it's wide enough that you can have some profitability, but yet still you're buying that out of the money call. So I'd be a little bit more bullish in that instance and able to get that done for a net credit to the account. So what type of underlyings do I like to do a skip strike in? I usually like to do them in more expensive underlyings. And part of the reason why is that you can go a little further out of the money. Gap openings aren't as big of a deal because even though on a percentage basis, it might not be a big move on a big underlying, but on a pure points perspective, you can actually manipulate the strikes a little bit better because I could go on out and maybe do a 20-point skip strike in something like Amazon ahead of earnings, which they're going to the FANG stocks are going to start announcing next week, as opposed to a stock like Apple. Apple's a little bit cheaper and it's a little bit harder to do in a little bit lower priced underlying stock. So it has everything to do with the skewing of the option contracts. And I want the option contracts to have lower volatility, usually on the call side, as we go further out of the money. We want that vol skew to be negative, paying up for the nearer term options, paying less for the out of the money option contracts. That's the first criteria. And then usually I'm doing it on more expensive underlyings just because it's easier to pull off. It's easier to make money on a butterfly if I'm doing it 20 points wide as expiration approaches and I'm right on my forecast than if I'm doing it 2.5 points wide. And that's part of the reason why I like bigger underlyings, bigger priced underlying to do the skip strike butterflies on. And I don't think I've ever mentioned that on the shows. I've gone in and picked skip strike butterflies a lot of times around earnings or not around earnings overall, but I've never really pointed out the fact that we're doing the skip strike butterfly because it's a more expensive underlying overall. So I love this question.
That's a good one there. All right, let's keep on rolling here. See how many we could squeeze in here, Mr. Brian. A lot of people want to get at you here. This handle makes me sad. You're not a noob, options noob. I'm sure you're writing into a show like this. You've already taken that first proactive step. So how dare you characterize yourself as a noob? Beginner. Let's go with beginner. How about that? Options beginner. It says, I read someone, here's your first mistake going on Reddit, but I read someone on Reddit recommend that you should buy the calls in the weeks. Let me start this sentence over. It's an interesting sentence. I read someone on Reddit recommend that you should buy the calls in the weeks when Powell talks and sell them the week before he talks. Why do you think this is? And do you agree? So, Brian, if I could interpret this Reddit speak here, this is he read on Reddit, he or she, that someone says you should buy call options. It doesn't say on what, so I'm going to assume probably broad-based index calls on the weeks that Powell is speaking and sell them the week before he talks. So maybe, I guess, a time spread? I don't know. Brian, can you interpret what Options Noob is trying to get at here?
I read it. I just read it as I want to buy a couple of weeks before he speaks. And then before he actually does the talk, I want to sell those option contracts and get out.
Okay, so, I can get behind that more than trying to leg into some weird time spread.
Right. So we're just looking for a volatility increase. So I'm buying before the news. I'm hoping implied volatility would increase, in particular, if we're talking about SPX or SPY. I'm hoping that the VIX index increases in anticipation of Powell speaking, which might be similar to an underlying stock that's actually going to be announcing earnings. Trying to think of other scenarios, but in the big marketplace, when Powell speaks, people listen. So the concept would be, all right, I want to get bullish on the market 2 weeks before the Fed's going to talk. I'm going to buy a call option or buy a put option. Then I hope that my forecast is correct. But if it is not correct, the implied volatility should increase, which protects me a little bit on my long call. Do not disagree with it. It's not as big of an issue usually around something like the SPY or the SPX or even any NASDAQ or Russell 2000 index or whatever you want to look at. It's not a bad plan, but you still got to be right on your forecast. And it means a lot more to have the direction right than the small pump up in implied volatility you might get because of the announcement that Mr. Powell is going to be having around the Fed meetings.
Yeah, it's an interesting idea. Options, like I'm with Brian. I can't really get behind. No matter how you interpret this question, I can't really get behind it. Let's keep on rolling. Okay, good for you though, options beginner. Forget the noob, options beginner. Good for you for asking the question, because that's how you learn. All right, let's keep on rolling out to, I like this handle, Bob Dang. Bob Dang. He wants to know, Brian, he's very nice. He addresses you directly. Brian, I have found Options Playbook to be an extremely useful explanation of the various option strategies. Oh, and the podcast is a great companion piece. Well, there you go, Bob Dang. Where do you get your inspiration for the various trades that you do on the show? Brian, you're always looking at some interesting strategy here or there and trying to apply them in the real world here on Options Playbook. Bob Dang wants to know, where do you find your inspiration for the trades?
Well, let's go back to a skip strike. If we're looking at a skip strike butterfly, for example, which has been a trade that we've talked a lot about, when do I want to do them? I'm looking around earnings. I'm looking when I want something where I would like a volatility crunch to come in. And if I'm correct on my forecast on any type of butterfly, I want implied volatilities to go down or time to decay. You can say it two different ways. So a lot of times I'm looking at higher priced underlyings that have an earnings announcement. That's one area where I might do a skip strike butterfly. So I'm with Options Playbook Radio. I'm more looking at pricing conditions that I can apply one of the 40 strategies to. Not necessarily that I really love this underlying or that underlying, because I want to try to make the playbook an actual playbook. Like we're 4th and 10. What's the play that we're going to do to try to get a first down in football? We have an earnings report coming out. What's the play that fits the pricing conditions right now? So not always looking just around earnings, but the other week we talked about Disney in front of earnings, and that's the time when I would like to look at calendar spreads. So we brought up a calendar spread. We were a month out from earnings, and that's the main reason why I did a calendar spread on Disney. It didn't have a ton to do with my forecast or my outlook for Disney. It was just that the conditions were right to look at calendar spreads. And that's another great example of when I might do that. So looking at earnings, looking at the price of the underlying, trying to find different scenarios where maybe a bull call spread could be better than a short put spread, and trying to bring that information out so that you can apply it to your own underlyings at different time periods of the year.
All right. Let's keep rolling, Brian. We're cruising through the backlog here. I like when we can carve through some questions here, because folks like to get themselves at OPR a little bit here. I like to indulge them and whenever possible. Next up, Options Queen. That looks familiar. She's one of our pro members out there. Options Queen wants to know, Brian, very straightforward question. What is your most successful options trading strategy and why? Interesting. Successful. That's a subjective term. Brian, what do you have to say for Options Queen? Wants to know, I guess, maybe what you've had the most success with in the Options Playbook, sir.
Well, To go along with Bob Dang's question, which dang, that was a good question.
It was.
I'd have to come back and say there isn't one that I think is in particular the most successful. I think managing your risk based off of what's going on in the marketplace is the best way to be successful in your option trading. So this recently, Stock Play of the Day, which we do on the Ally YouTube channel, we looked at a trade around an underlying stock that has been in the news, and we managed our risk not by just buying a call outright. We did a long call spread. We were still bullish. Stock was up quite a bit over the last couple of days. And part of the reason why we did the long call spread is we wanted to manage the risk and say, I'm going to risk $1, but if I'm correct on my forecast, I can make $3. And I'm managing my risk on an underlying that's already made a big move to the upside. And I'm going to say, well, yeah, I can manage risk by saying, I'm going to get out if it's down. But I'd rather use a spread strategy like that to say, this is the maximum I'm going to lose. If I am correct on my forecast, I have the potential to make up to $4. And if I'm incorrect on my forecast, I'm only going to lose $1. So that's the most successful, especially for beginning option traders, is getting yourself in a position where you are truly using options to manage that risk overall. And then you're sticking to your forecast and sticking to your plan. So I don't have the most successful option strategy overall. I'm just trying to use the playbook in general to come up with the best case scenario based off of what's going on in the marketplace.
If you had to go to, though, your favorite, forget successful, just your favorite, is it the skip strike or the fig leaf, sir? Which one would you say is your favorite?
Skip strike or the fig leaf? I guess it would be butterflies. I like the dynamics of a butterfly. And if you want to go that far along, Mark, one of my favorite things to do is to start with a long call spread. And then if I'm incorrect on my, not call spread, it could be a long put spread if I'm bearish. But if I'm incorrect in my forecast, roll it into a butterfly. So it's kind of a two-step process where I'm looking at it. I think I'm going to be correct. I'm wrong. Oh, no, I don't want the cheese anymore. Let me out of the trap. Let me just roll this into a butterfly and see how much of a credit I can pull in and reduce my risk, but still have a toe in the water, if you will.
I like that. I call that inertial trading. When the trade goes your way, you kind of adjust it, or maybe if it doesn't go away, you do a little bit of adjusting.
So you have a plan. So you put that on. And I've talked about that on Options Playbook Radio, specifically around the SPX when the VIX is a little bit higher. That's one of my go-to strategies on a short-term basis around index options.
All right. Let's see what else we've got here. We got a live one coming in from Nichols, one of our other pro members. He says, has Brian thought about making an updated version of the playbook to incorporate all of the meme stock volatility developments from this year? So, Brian, we get asked about different flavors, different variations of the playbook all the time. Nichols wants to know, have you thought about maybe a meme stock addendum to the playbook, sir?
No, not a meme stock. I've thought about a different playbook, but the playbook would be a little bit more about adjustments than just flat out strategies. I don't know if that would happen. It entices me, and I do think about it. But like the strategy that I just mentioned is something that I think is interesting, and I would get more into the minutia as to why we are doing a skip strike as opposed to a butterfly. And I think that would make an interesting book overall. But it'll be more of a book than something where you're just gonna flip it open and every strategy is discussed in 2 pages. Right. So you get into a little bit more of the minutia behind trading and the concept of it.
I think the meme stock playbook would be about 2 pages. It'd just be buy calls. That's all anybody does, right? Buy calls. Oh, you like this name? Buy calls. That's a pretty short book there, Nichols. A fun idea nonetheless there. All right, next up, we got Beals with a Z. Beals, maybe? Let's go with Beals. Beals wants to know, does Brian think the one lot volume explosion will continue for the rest of the year? If not, what makes it fizzle out? Well, Brian, one of the questions everyone had on their brains coming into 2021 was, can the party continue? So far, at least, the answer is a pretty resounding yes. Q1 was the busiest quarter in the history of the options business. Every month, pretty much doing more paper than the last. Every month, pretty much setting a new record. Kind of tapered off a little bit, but towards the end of Q2, came roaring back to life. We have the numbers for June now. June was the highest June ever in the history of the business, up I think around 25% from this time last year, which I mean June of 2020 was no slouch. And then it was the second highest month ever. So even in the traditionally summertime, not the most, rock'em sock'em robots periods for options volume, still second most active month in history. So Brian Beals also wants to know, what do you think about this, as he puts it, the one lot volume explosion? You think it's going to continue? And if not, why not, sir?
I do think it will continue. I think as people learn about options, it's just becoming more palatable for people to invest in them. And one of the biggest things, obviously people had more time on their hands. They were at stay at home. That contributed to this, but other things are just better markets. As the markets get tighter, it becomes more feasible to just buy a call option as opposed to buying the stock outright. And Mark has mentioned already a trade that I have talked about quite often is a fig leaf. And I've looked at bigger underlyings, and NVIDIA was a great example. As a matter of fact, I think we talked about it on Options Playbook Radio, and just looking at buying an way out of the money call option prior to the split, way a deeper in the money call option prior to the split, as opposed to just buying the stock outright. And part of the reason why is that the longer term option contracts had fairly decent markets on it. And, you're talking about stocks, you're looking at 1 cent markets, a penny wide. But in the options world, when I'm seeing 90, 180-day, 200-day option contracts trading for a quarter-wide split on in-the-money option contracts, you're only looking at 25 cents between the bid and ask, and you can work it a little bit. I think that really drives a lot of the volume, because if that were the case, if we ever got to penny-wide spreads on deeper in-the-money option contracts long-term, heck, I don't know why anybody would really want to buy the stock. Why wouldn't you just rent that stock, pay a lot less, have a lot less risk overall? So that excites me as far as option trading is concerned, especially in the one lot area. And I would like those one lots to be in the money option contracts as opposed to the out of the money ones overall, where I'm just pure speculating. I'm buying a little bit of value, and I'm getting what I'm paying for by going deeper in the money.
I like that notion of renting the stock. I think that's an interesting one, an interesting way to couch it. But you're right. I think the industry now has this challenge, right? The first challenge everyone had was, where do we get new people? Now we got them, right? Now the next challenge is, how do we migrate them away from far out of the money lottery ticket calls into something that might have a little bit more bang for the buck for those people out there? So that's the next stage. Hopefully a show like this can contribute. Options Playbook, everything you guys are doing over there at Ally can go a long way towards migrating those folks into trades that will perhaps turn them into much longer term successful options traders. All right, next up, we got P&L Man. I do believe this is another one of our pro folks here. P&L Man says, hey guys, love the show. Well, right back at you, P&L Man. He says, I'm still new to this whole options trading thing. Well, you and a whole bunch of other people, P&L Man, so have no shame about that. You're doing the right things. You're learning. You're trying to improve. You can't ask for more than that. He goes on to put, what, if anything, should I take away from this new era of VIX below 20? And should I make any changes to my trading as a result? Interesting. Brian, this is something I've been talking about a little bit here on the network for the last couple of weeks. For people who've been doing this for a little bit, VIX coming back below 20 is no surprising development. This is something everyone's expected for some time. For people who are newer entrants to the space, maybe you got into options when the VIX was in the 40s or the 30s or higher. Who knows where it was over the course of the past year when you first really discovered options. So their frame of reference, Brian, is a very different thing. And they're used to a much more volatile environment. So to them, a VIX shy of 20 is anemic. That's like zero vol to them. So what do you have to say to P&L Man and everyone else out there who's looking at it and saying, now VIX is below 20. Does that really mean anything to me? And should I make any changes going forward as a result?
Well, it's a little bit what Options Playbook is all about, and what this actual huddle that has been covering a lot by all the questions is that when the VIX does come down, you adjust your strategies accordingly. In general, you're going to do very similar stuff. You're not going to do you're not going to change your outlook on underlying securities just because the VIX is at 15. You'd be more looking at what's going on in the marketplace. But overall, a lower VIX usually means that the marketplace is becoming more comfortable with where the S&P 500 index is at, the Dow, the Russell 2000, all the major indexes overall. So I'm not really going to look to adjust it, but I might adjust a strategy. I might change it up a little bit because the VIX is below 20. And when I'm talking about the VIX, I just like to talk about the S&P 500 index. I would rather do a butterfly in the SPX with the VIX around 20 as opposed to, like, I'm just thinking a one lot butterfly, as opposed to the VIX being at 15. It's cheaper overall to kind of take a shot with the butterfly because you're selling two option contracts, and that premium you want to get as much as you can when you initially put on that trade. So I might adjust the strategies that I'm using a little bit, but I'm not really changing the fact that I still got to be right about my direction, and that still means more than any volatility movement overall in general. But a very good point, Mark, what you're saying. If all these one lot traders have came in, and when they were trading those one lots, the VIX was probably at 40 when they first started.
Well, Brian, we have a huge list here. I'll let you pick one more here before we wrap up. So if you have one that really resonates to you, scroll through and have at it while I just pontificate on this a little bit, because you're right. This is an interesting topic. Just something I think everyone out there who's out there trading now, maybe you're new listening to this program, you're kind of a newer options trader. Just keep in mind that this is, even though I think we're at about an 18.25 today in VIX cash, we're at a 22.5 a few sessions ago. So we're whipping around from a vol perspective. Just because you broke through 20 doesn't mean that vol is anemic or vol is low. In fact, historically speaking, we're still at a very elevated level of volatility. VIX isn't normally hanging around in 18 to 20. Usually it's lower. That's a conversation we've been having on our Vol View show for some time. But in general, the long-term average for the VIX from a practical perspective is actually much lower than where we are right now. So this is actually fairly frothy still, even though it seems like it's not that much. So bear that in mind when you're thinking, oh my God, there's no vol left. I should stop selling all options and I should do nothing but buy premium. In reality, there still is a fair amount of vol. And that vol of vol, the volatility of volatility, is still very frothy. Vol is moving around quite a bit. We could be back at a 30 before you know it. So just bear that in mind if you're thinking, oh, this is it. This is the end of volatility. If you want to see that, go back to all the shows we did back in 2017. That was pretty much an entire year where VIX was at or around single digits, and it stayed there for pretty much the entirety of the year. Now, think about that when you're thinking about a VIX as an 18 to a 20 of being low, and that'll give you a little bit better perspective on all that. All right, Brian, I bought you some time. Is there one more question you really love you want to squeeze in here, sir?
Well, yeah, let's do it. Let's look at Jeff's question in the document a little bit, because let's just stick with the skip strike butterfly theme overall.
You picked an epic one. I got it. You picked an epic one, sir. All right, I'll do my best.
Yeah, it's a little bit long.
I'll do my best to deliver this one. All right, here we go. This comes from Jeff Benedict. He says, I have some questions about paper trading a split wing butterfly. I went into my options account yesterday afternoon. Under the options research tab, I was able to place the following paper trade in Amazon for a midpoint credit of $1.35 with an expiration of 2 days. Also a pretty near-term one. He bought, I think this came in a little while ago, so maybe these numbers are a little bit different than where he's trading now, listeners. Said he bought one 1975 put, sold two 1995 puts, and then he bought one 2005 put. So he's skipping the old strike, Mr. Bryan. Says, my question is this. To close this paper trade out, how do I know what my actual credit or debit is? If I place the same paper trade in Amazon right now, it would be for a credit of $5.88 at the midpoint. Since I didn't actually place this trade, I can't actually sell to close and buy to close this trade to get the real numbers. I think what's confusing me is since I, quote, bought the butterfly to begin with for a net credit, is my actual take-home credit the $5.88 minus $1.35, or is it $5.88 plus $1.35? Or is the $5.88 actually a debit and I just lost my shirt? Thanks. This is actually a good question, Brian. There's a lot to unpack here. Sometimes we talk about butterflies a lot. Sometimes the actual mechanics of how these things work get a little bit lost in the weeds. It's particularly confusing. I get his point around paper trading because you're right. You're not actually placing a trade. So you're kind of just guesstimating at where you got filled. So, Brian, what do you have to say here for, what was the name here? Jeff wants to know about his Amazon paper traded, easy for me to say, skip strike butterfly.
All right. So a couple of things that I wanted to highlight here is that this is exactly why I talk about them in underlyings like Amazon. And I really like the fact that he picked 2 days, because in 2 days time, all that premium has to come out of those option contracts because expiration is approaching. So he was able to go 20 points wide, which means it was a real trade. And once again, that's because it is a little bit more expensive underlying. He did it with 2 days remaining to expiration. So I like that. So overall, I'm guessing that the market probably moved in his direction, and he could close that for a net credit. And the number he used here, midpoint of 588. So somewhere close to that. Amazon's very liquid, so you can usually get fairly close to the midpoint overall. Not a guarantee by any means. So yes, you probably put it on for a net credit of $1.35, and you probably took it off or you probably could take it off for a net credit of 588. So I bought it for a net credit, and well, I guess we should say it's kind of tough with butterflies. You should say I opened it for a net credit and I closed it for a net credit. And that's what's really fun when you're correct on your forecast with a butterfly, in particular a skip strike butterfly. Now, one of the biggest things about that, though, is that you did add risk. You brought in $1.35, and it's nice to get it done for a net credit. But this trade overall would have had a $2,000 max loss in that by skipping that one strike. What you're really effectively doing is selling a call spread to pay for the butterfly. That's really what it is. And that call spread would have been 20 points wide, which means the margin would have been $2,000. So this is and I've even gotten confused when I'm looking at a trade and wondering, I put this on for a credit, and can I really get out for a credit? Because it is very mind-blowing that you can do something like that in something like a skip strike butterfly. And I liked a lot of these trades when vols were higher, just because, first of all, you didn't really know where the market was going overall. But the biggest thing is if you add too much time to the skip strike butterfly, and the market starts going against you, even though it's going in the right direction, the biggest thing that can be tough about a skip strike butterfly, if it does it too fast and you have too much time, that can actually work against you in those trades. So they're not there. You definitely need to look at something like a profit and loss calculator. We have one in Ally. Most brokerage firms will, to see how this trade changes over time. And if you're a little bit scared about the paper trading, take some time and understand how to use a very good profit and loss calculator. And it can show you exactly if the market goes in your direction, on what day, in theory, would this thing basically change to where I want it to continue on up. Well, this one was with puts. I apologize, but I wanted it to continue towards my strike price or my short strike of my skip strike butterfly. That's a lot on that last one. You might have to rewind it a couple times.
It's a good one, though. It's a good question. I can see where
really good question.
I can see where he's coming from. Anyone who's
happened a lot.
Yes, anyone who starts dabbling in butterflies will quickly get this, because you're right. It depends on how good your broker is, how well I've had brokers myself. I'll trade butterflies, and I've had brokers myself show me something that they say is for a credit. Then I'll look and say, that doesn't make sense. And I'll start pricing it up. And sure enough, it's actually a debit, but they listed it incorrectly. So very important to pay attention to the executions on these butterflies. So that's actually a great question there, Jeff. And great questions to everybody out there. We have Bob Dang, we had Nichols, we had P&L Man, Beals, Nims, Options Queen, Options Noob / beginner. Whole bunch of you out there. Glad to see so many of you are enjoying, getting a lot of value out of the show. You guys are the reason this show exists. So keep tuning in, keep listening. If you're listening after the fact, keep rating and reviewing on whatever podcast platform you're getting. It really does help new folks continue to discover Brian week in, week out, and that can only help them and their trading going forward. And Brian, for all these new folks who are discovering you and the Options Playbook, they want to learn more, maybe they want to ask you a question, or they want to check out some of that content in more detail, where should they go? What should they do?
Well, they can send me an email directly at theoptions with an S guy at invest.ally.com. One of the best things to do is just follow me on Twitter. Handle is @BrianOverby, at my name. And anytime we have something new, not only happening on Options Insider Radio, but also inside the Ally Invest Zoom platform or the Ally Invest YouTube channel, I always tweet about it. So please check out my Twitter feed. And thanks for listening. We'll be back to the same time, same place next week. Until then, may all the options you bought finish in the money and all the ones you sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.